I'm a VP at Ankur Capital. My name is Shiva Shanker. I've been with the fund for 5 years, and broadly at Ankur Capital, we focus on a few verticals, primarily looking at sectors like AgriTech, healthcare, medical devices, Fintech as well, and we also look at some of the other spaces around education skilling and also deep tech companies. Broadly from our side, we're managing a $50 million fund right now, and we normally start off investing in a company between $500,000 and $1.5 million. And through progressive rounds, so staying in the company from a seed to a Series B stage, we invest up to $5 million as we continue to invest over successive rounds. So a typical VC fund, whether it's a micro VC or a traditional VC, would be a fund that's been allotted capital by their investors for an 8-year life. Normally, legal structures in India would be 8 years plus potentially extensions. So they have this pool of capital they draw from their own investors for investing into startups for around 8 years. But that's the total life of a fund. So since the first time they would meet a startup, maybe a couple of years into the fund life, typically a VC is someone who's investing a pool of capital by someone else. Typical fund size may be somewhere between $10 million and $50 million in the current investment scenario, and would be investing $1 million in a company, and typically would be looking to have a return horizon of around 5 years. As an investor ourselves, we all invest to some limited extent in the public market at least. You know that your own expectations of the Sensex is that generally if you invest even in a generic index, that you'd want to be getting double-digit returns. So this is a market that you can sell your stake, get liquidity on the same day, that you're still expecting to get a 15-ish% return. Now what you're asking is how an investor who is locking in capital for 8 years and really saying I'm in a riskier category where I may not get visibility, may not be able to sell my shares for a longer period of time. Inherently, the rate of expectation is much higher for a venture fund for these reasons, that coming in very early stage companies, you have a much riskier asset that they're putting money in. So the investors' interests are that they will get a much higher return on any of their successes ventures. And when you merge that with the fact that the venture funds, and just historically, if you look at a study of the venture fund industry, there's generally a power law that gets outlined, which means that the best performing company from a venture fund's portfolio will normally have a return that is the sum of all the others. So 50% of your return is only from one company. So if you just put those two levers together, typically what that means is a venture fund, when they're investing in you, would want to, if you are the best performing, get at least a 10x return on the money they've invested, because they want to be able to return the fund from the most successful investment they're doing, at least. Because that means on an average basis, if the rest of the portfolio looks in a certain way, they would have made 2x their return, which is roughly 12-15%. So it's not even that attractive when you put those levels in. So that's why a venture fund has these types of return expectations of saying the best guy in my portfolio, which probably there's going to be one big winner, will normally return about a 10x return, but even that is just getting them to a pretty average return. So that's why the expectations in the industry are for such high returns. A few different ways that we look at it. One would be the fact that at an early stage, I think the idea and the concept of what you're doing may be similar to some other startups that we've seen before. So it's really important to position of what's unique about the team, what's unique about the founders, what is something in their experience, the traction, the way they've understood a market that really allows them to have a very sharp understanding of this segment and allows us to back them. I think the founders and their understanding of the market is critical. And if you just look at any of these segments where we started off with 20, 30 companies, which any of the consumer segments we look at as well, right from e-commerce to looking at home services, we all had dozens of companies start up there that raised capital as well, but only really one or two survive long term, because there is a skill of the founder that is very critical. So that's the biggest point. The second would be for the specific model you're looking at, is the model going to be the same as it scales up? And or is this an entry system that you're really pitching to the founder, and is there a bigger picture? It's fine either way if the model is the same through the long term, or if there's going to be a sharp pivot, but the founders should have clarity in their head of here's how I start interacting with a market where I can capture value from a market that is probably tens of billions of dollars. Because if you look at what we went back to in prior part of our discussion of how big a venture fund wants you to be, They want to actually see a company that can actually be worth $1 billion, because that's the only way their own percentage holding in the company at that point of time is significant enough. So you need to be in a market, maybe not immediately, but in a market that is a 10 billion plus market as an opportunity that you can capture significant value from. So I think the pivot is a very natural progression of how the company could go. But I think it's what has stood out and gotten us to the seed stage founders that we have also backed is an understanding of saying this is the first part of what I'm doing, and this may be a growth hack to get into the larger market. Or here is some of the other opportunities I will explore depending on how this reaction comes from these sets of customers. So while you may still pivot to a different model completely, generally you'll have an idea saying the first business model should give me these indications of these are the big business avenues and the big business markets I can actually grow into. My first thesis is we will be going towards X, but there may be a challenge that comes up in the business. Customer set behaves very differently that says we drop the model completely and we start doing a different segment. That does happen, but typically what you would find is a more natural progression of saying we took our first step in X and we had these 3 doors open. The first one, which we thought was the most natural fit, didn't work, so we started looking at the others. It is still somewhat aligned to what you were doing earlier. So I think having that understanding that's communicated by the founder, I think a lot of people have it, but don't communicate it out to their VCs as they're pitching of this is what I think the market will grow to, but in case these are the challenges I'm visualizing that could come from customer reaction, competitive environment, etc. Here are some of the other avenues that are open to me that at that point I can start to explore. Having that clarity of what those are can be really valuable to a startup early on. So just when it comes to the pitch decks, I'd say ideally not going too long into what you're pitching as the initial conversation with the startup, with the VC. I've had startups actually come to me and literally take a full 30 minutes to pitch, try to explain their model. If you're pitching to a VC, go in and actually you can start in by asking them questions of have you seen models around this? That'll help you understand, okay, I don't need to worry about going too deep into market context, into competitive environment. They'll have some understanding of these segments. Try to keep the pitch itself to about 10 minutes. So typically what that means from a slide structure perspective is you'd want 10, 12, maybe 15 slides as the core deck. You can have additional supporting material that's ready for you in case there's questions, answers. But it gives you a core fundamental of saying this should be able to crisply explain my business model in a more condensed deck. It doesn't mean you put like every single word is still stuffed in. So content is also light enough so that someone can read and be able to pull away. So I think there's a balance, but try to do it within a 15 slide deck. Some of the areas to make sure you're calling out. Obviously call out the team, explain why you are the right people to be able to build for this venture. Having the market environment and here's the industry context. So it's there as industry size, the way that you are seeing it evolve that may be small today but can take off in the future. And also call out the competitive environment. I think if you call out these large areas, may need more than one slide for a single one of them, but I think those are the 3 that are absolutely critical to build off. So that can be different based on the different business models and how the industry is set up. Typically, there'll be a few restrictions, of course. There will be industry benchmarks that exist. And for example, SaaS, you can look up what the publicly traded companies are actually trading up at a point of time. And that gives you an idea of if you're a SaaS company, here is what multiples you can be expecting as you become a mature company. At an earlier stage, it'll probably be on the higher end anyway. But here's what it'll be as you mature. So as you are early stage, you can actually do a backward calculation of saying, for us to get to be at that stage, it's typically taken 5 or 6 rounds of funding. This is how the multiples across stage looks. And there's ways for you to actually have proxies for that when there's a revenue generating business. Not all revenue generating businesses will have easy proxies. Some of them are very low margin businesses that where revenue also may not correlate with the underlying business. So you may have deep IP businesses that are actually built out. The revenue probably is less relevant than the strength of the IP in those cases. So it can vary on the business model quite substantially. But generally, I think where people are pitching to us and saying this is the investment ask, having an understanding of where that can go and what the structure of the round is, I think just becomes important variables to understand overall. As a venture fund, there's restrictions of what is an investment size that any individual fund can do. Some write checks that are up to $500,000. Ours is $1.5 million to $500,000 to $1.5 million. There's some that on average will write up to 4 to 5 million. So depending on the stage of the VC, you need to know that you're in a comfort zone that it works for them, and that the use of funds is something that reasonably you can actually utilize and deploy to achieve your targets within 12 months. Sometimes we've had people raise capital or try to raise capital for 2-3 years, but realistically you need to show that you've been able to deliver on those targets in a 12-month horizon to be able to attract the next round of capital. So those are some variables to just think about in how you're looking at the quantum of fund you're raising. The valuation itself does vary based on what is realistic for you to deploy to meet the targets to attract the next round. What are some of the public market peers that are already there in a comparable segment of a business model, at least, maybe not for the same business, because that is going to be early for all your other peers. What the VC's own real restrictions are from a fund perspective, because normally if a company is raising their first few rounds of funding, you probably won't get a VC who's taking only a single percent holding. They will have restrictions of how the funds are set up, that inherently they will be looking at something around a 15% for the fund itself, and if you're looking for multiple funds, specific contours that need to be reached. But those are all variables that you need to be aware of as you're raising. Yeah, so I normally break it into two variables because the first is really up to both peers as it stands. The second is really in the company's own discretion of how quickly they can get their stakeholders to coordinate. So broadly, from a VC, from the first contact, what you're looking for is a significant intent that they are willing to actually lead or participate in your investment round, at which point they'll issue you a term sheet. Typical timelines would be that right now, a lot of VCs will do it in a month, some will stretch out to be 2-3 months, but probably shouldn't be longer than that. So from the time you're engaging with them, if 2-3 weeks have passed, you should ask them, how quickly can we actually move to a term sheet? Are you guys interested? What are the questions we need to ask to get to a term sheet being signed? The term sheet is significant for a few reasons. It outlines a lot of the fundamental terms you'd want as a founder. Of course, valuation being one, but also in case there's other control rights or other rights that the VC will have, it'll outline those at least at a high level. And you'll also, at that point, once you've signed off on the term sheet, they'll at that point trigger the external providers they need to, from drafting the legal agreements, conducting legal financial diligence. And that's where the ball is in the company's own court to say how quickly can the data really be available there. We've had diligence and drafting done and dispersed to companies within a month of term sheets being signed as well. But it has stretched on for 3-4 months as well. So it is up to the company really to make sure the data is readily available on day one so that the timeline to get money in the bank is minimized for them. Yeah, so one, to just see that they actually invest in your type of business model or your type of sector. Normally, most VCs' websites will at least call out their portfolio, which will give you a directional indication of do they do things like this. You can also probably ping a founder or someone at the venture fund on LinkedIn of saying, I'm in this space, I'm working on this type of sector. Is this something you guys are interested in? It'll give you an idea of saying, do they actually work in this? Also worth checking if they have a competitor that's directly in their portfolio. So if there's a direct competitor already in their portfolio, probably want to avoid them unless there's a specific way that they have been able to give you comfort that there is a way they're managing conflict. Most VCs have their full portfolios on their website. So once you know here is here are VCs that actually invest in my segment, probably there's 2 or 3 direct peers that you are wanting to track. So look up their investors to see who are the ones that from press releases, etc., have already been announced as investors, and probably just say, this is not the list that I'm going to go after. So of the 60 odd that probably invest in my sector, here are 10 that I want to actually drop off because they're in the direct 2 or 3 competitors that I am looking at. So that will give you a shortlisted pool. The other thing to just look at is if your check size is actually mapping out as well. So we discussed this earlier, that a VC may be looking for, have their own specific holding amount that they're looking for in the check size. So if you go to a micro fund who can only do up to $500,000 saying, I want to raise 10 million in a specific round of funding, that structurally wouldn't work for them. But if you say, I'm looking for $1 up to $2 million, and you know the average check size for them is $500,000, it's at least close enough for them to say, okay, this is not a big bridge if I need to structure something. Both of us should be able to find a way. So I think making sure the investment ask also relates around what the VC has done, which normally you can find by just Googling the fund. They'll normally have press releases saying, here's, they've invested in a certain round, which was X million dollars. It'll give you an idea of saying, is my investment ask roughly in the range of what they do. So I'd say those are good ways to actually benchmark. So get a list of funds together, do some basic Google searches, you'll be able to see what are the type of transactions they've done, and yeah, move from there.